right. So start recording, everybody. Welcome. This is our master class. This is for our vol class. So also a question. Next week's class, Mark wants to teach. It'll be on Wednesday at 7 Eastern. If that creates massive problems for you, let me know. But I know when we set up a class time on a date, it makes life easier for everybody. But he's going to do a second set of VIX trades, or VIX trading based on kind of the method we talk about today. Okay? So let me know that's a problem, but it will be 7 p.m. next week. Okay? All right. As trade go, I think we're 3 for 3 for trades. This is the position we looked at. The kind of the underwater strangle for VIX, right? Do you guys remember this from last week? I think we looked at the Feb 08, unless I'm losing my mind. You could have sold this put for $1.50 pretty easily. Okay. Now, when we were doing these, when we were looking at the trades for the first 3 vol classes, because we were trying to kind of set things up to some degree, what I wanted to do was say, hey, here's some volatility trades. Okay. Here's an introductory to volatility that we did. Okay. We are not going to go into skew or term structure per se anyway. We're mostly just trying to focus on using the VIX futures and vol products. That's pretty much it for this course. So we're not going to use skew. We're not going to use term structures, but I could see those being, courses in the future. So what we were looking for here is, when I'm looking at VIX, I like strangles that are underwater. Okay, so I'm going to outline those reasons. Right, we're going to talk about it a little more. We're going to price them a little more. Try to get through some sort of process for pricing them. And one of the reasons why too is, one is it offers a natural hedge to, basically a long, let's call it a long delta portfolio, or if you sell premium that, where you like to sell put spreads and stuff like that, it would be a natural hedge. Okay, but so far, at least I believe, we've come up with 3 vol trades. The reasons for that we have had for them, I understand, but maybe you don't. People that are in our strategy, in our chat room on a daily basis, probably get it because they've been seeing this stuff over and over and over again. But hopefully, with this class, we'll start to. I want to put more of a method behind looking for the positions. Okay. But anyway, one thing is just to remember, what I want you to keep in mind, what made this position interesting, right? If you guys can recall from last week, I know there's been a lot of life from last week to this week, but do you recall the generation of why this was something that caught our interest, right? And why didn't we just go, hey, I'm going to be long VIX, right? VIX is at the bottom. Why? I'm just going to get long it because it's going to bounce, right? Do you recall the reasons for that? Right. Well, we have a hedge, but part of what we were trying to talk about last week is everybody buys VIX because they think vol is going to pop, right? Oh, it's trading 11, right? And clearly, this strangle gaining in value, something else has to be going on, right? How does this strangle gain value? Nope. Thank you, Kurt. Thank you, Tim, right? The futures decay to cash. Okay? It's a key element of what we're going to talk about. Okay? Thank you, Michael. Right. But the thing what I want to concentrate on is what the market's expecting, and then learning how to hedge against it, learning how to price. Okay? So let's start with that. And then of course we're going to quantify the risk. So hopefully this will get things going. Okay? So this is our fourth class. All we're going to do is focus on the VIX options. Mostly short-term options. Marco's going to talk about backwardation and ratio spreads and flies next week. Okay? So we're going to stick really to a narrow part here. And I should say, whoops, what I want to say here actually is I want to option put method for contango. Oh, I said that on number 4. Never mind. I'm good. Okay? So we're going to talk about the method as far as identifying edge, quantifying risk, pricing the position, understanding the management. Okay? That's the method, right? We're going to kind of continue to do that with all of the trades we see this week. I want you to be able to identify something that you think has edge, right? Either that, you just, I'm going to buy VIX options, VIX calls because I think the market's going to bounce. Okay, which is not really easy to do, by the way. So we'll talk about VIX options and the speed to cash, meaning what actually drives the pricing of them. We're going to talk a little bit about the VIX and the SPX, meaning if the SPX does something like today was kind of a curious day, right? We had that rally in SPX, but the vol futures really never backed off much. Okay, so we'll discuss that a little bit. It's a little curious. And that's another thing we talked about as far as vol went last week. You expect the SPX volatility to go down. Well, the thing is there's a couple reasons why the futures go up, but VIX as today itself, right? It finally dropped a little bit at the end of the day. It actually traded very low for a while. It's just the problem is too, Michael, I think it's getting low, and it just once things get really low, you need to make you need to make a little bit more of a move to get it to happen, to get VIX to actually move. The problem was we never really rallied enough. We never really sold off enough. It's kind of in that. The only thing I could say, which is why we haven't added a lot of vol product trades, is we're sort of in the I don't know where the hell we are phase. Right? I think the vol products as a trade right now are kind of difficult. That's why we've kind of been sticking to like VIX ideas, because we're really looking for more pins on the future and the cash, and not necessarily, some kind of move out of the vol products. Right? Because we just kind of have this drippy contango. So when Mark does VIX next week, we'll start to discuss the vol products the week after that. Right? This is week 4, week 5, week 6. Okay, and by the end, we'll do vol products versus the index, the SPY or the SPX. Okay. Trying to look for edge in contango, I have kind of a narrow definition of what that is. Right? Now, there should be a hint from the last class. The problem or the good part of these vol courses is you have to know what we taught you in the first 3 to understand what's going to happen in the 4th. Okay. It's like anything. You have to kind of understand your fundamentals to understand how the trade might work. Okay. So, and then we're going to price our strategy right. So this is, I came up with this weekend, and I've decided a lot more of our stuff at Option Pit is going to be in this direction. Although identify the opportunity could be in any product with any strategy. In this case, we want to try to quantify opportunity with the VIX futures. Right? What makes us want to trade it? Right? You can have opinions, right? My opinion right now is what happened today and yesterday and the day before is probably going to happen tomorrow. That's about the length of my opinions on all this. Right? So if that's my opinion, what strategy fits that? Okay. Oh, somebody's asking for something already. Let's see what it is. Hold on for 1 second. So what we want to try to do is, to the best we can, try to fill in our questions, answer our questions. Okay? And then rinse and repeat just means we're going to use the method on the vol products when we're in backwardation, when the vol futures are flat, when VIX is 45. Okay, it's the same concept. It's just the market does different things every day, so we just have to figure out where things are that could be interesting for us. Okay. So here is, again, reviewing. This is, I have to say, just conceptually for you, you got to get this. You have to get VIX parity. So if you have questions about it, now is the time to ask. Right? If you want to trade VIX options, it's the way it is with how this product is. If you don't understand the parity concept, it's kind of hard. So I'll ask you now, does anybody not understand parity with an in-the-money option or an out-of-the-money option, which would be the opposite of parity, extrinsic value? I don't. Okay. So the concept of parity is this. Okay. Do you see where the VIX is? 1137, right? That's the snap that I took, I believe that was this morning. All right. Do you see where the 13th strike is? Okay. The difference between 1137 and the 13th strike, because the put is in the money, right? 13 put is above the strike. So this put, this strike is $1.63 in the money. Do you see that? Okay. The problem is the put's only trading for midpoint $1.05. Why is that? Would you want to pay $1.05 for something that's worth $1.63? So the normal response to that for everybody would be yes. Right? It's in the money. It is in the money to the future. Okay? Where is our future right now is 1245. So VIX doesn't price, the options don't price off the cash until when, right? So we talked about last week. These options are not going to price on the cash until what date? February 15th in the morning. Right? So almost everything that you do with VIX has to deal with the relationship between whatever the future price is and whatever the cash is. What increased to $1? Oh, the in-the-money value? Oh, yeah. What did we close? 1129. So this was a trade we were looking at in our chat room pretty much all day. The hardest thing about this class is you're trying to find specific examples of stuff. Well, I mean, that's the thing, Michael. There is sometimes the futures get held up for particular reasons, like they're rolling from one term to the next. With VXX, now you're moving out of Feb, you're getting more heavily into March, so you're dumping your Feb. In this case, they'd be selling it. So I don't know why there's a bid. It could be hedging. It's just you never know exactly why, right? But the important thing, at least for this, is the concept of vol gravity for us is simple, meaning if nothing happens, what is the value of the 13 put if we close at 1137 or where we close today at 1129? If the vol sits, that put does have to be $1.71. That's why I think it's a juicy. That's why I think it's worth doing. Well, that will be our trade at the end of the day or at the end of our class. We just have to price what's a little cheaper. But what I'm trying to get your head's got to wrap around what the position expires to is a known, meaning if we close 1137 or today's closing price is 1129 for VIX, what is that put going to be worth even the day before expiration, right? It's going to be worth at least parity plus maybe some intrinsic value, or I'm sorry, some extrinsic value a little more than parity. Does everybody get that? It's a pretty powerful, it's just how options work. So the way I think about it is when the market is like this, I view this as edge. Does edge mean it's a guaranteed winner? No. What edge means to me is I have a head start. Right? And when you look at how these trade and when we look at how VIX trades and how long the premium actually kind of stays there depending on how you price stuff, right? Because I always like to just do one little move to try to save myself 25 or 30 cents on the trade because that's usually kind of the decay profile, the actual option decay. So again, we'll talk about that. But what's important is my assumption, and this is an important assumption, maybe people disagree with me or not, is I'm going to assume if everything stays constant, that this 13 put is going to be worth at least $1.63, or today anyway, today's closing is $1.71 on the day before expiration, if this VIX cash holds. Right? Now, that future might not be all the way down there, but it's going to be really close by that, right? So if you remember in the last class, you remember how VIX futures start to decay as you get to expiration, right? What's important about this future is what should this future be worth about right now? The Feb 15 future, we have cash at 1137. What should it be worth about? If you remember our last class. Remember, the future. 1187, $12, right? It should be a little lower. Right? The future itself should be, I would say, 50 cents to 75 cents tops. So even at $12, I view there's like a half a buck in there. Okay? And we'll go over that. Well, the important thing is my opinion about volatility doesn't mean shiitake, right? If you go, VIX is low, I think it's going up tomorrow. Okay, this is not the product to trade that, and you're going to see why. Just isn't. there are other ways to trade that, right? We can look at time spreads in the SPX, all kinds of other things that will be actually more vol sensitive to this. The fact that this future is $1 over the cash with a week to go essentially means this product for small moves in volatility is actually fairly insensitive. Right? If you don't understand that, again, ask now. Okay? Part of the reason why the VIX is interesting or trades a certain way is because the skew is set up, I'm not going to say the opposite of the SPX, but kind of. Meaning all the cheapest options are near the money. Okay? The most expensive options relative are out of the money. Now, think about it from this point of view. If VIX is trading 12.5 and I expect it to be, let's say, 11.29, or let's say 12.45 down to 11.29, that's almost a 10% move in a week. Right? That's a fairly big move for a small product like that, for a product that has a small price. So the fact that the near the money options are so cheap, what does that lend itself to for us? Right? If you took the Gamma class this weekend, right? The way VIX is priced is the cheapest options are always where? Right? So if you look at this chart, right, the most expensive options are way out of the money. The cheapest options are always where? Are they near the money? Are they at the money? Where are the most inexpensive options on from a volatility point of view? Right? Relatively near the money. Okay. So if I can create trades that have the potential to have a kind of a solid move, but I get to buy the cheapest options and sell the most expensive options, don't you think that sounds like a decent deal? I'm looking for a relatively high move in percentage terms. The options I get to buy to ride that move are the cheapest in volatility terms, meaning my cost is the least. And I get to sell possibly the most expensive options against that. Doesn't that sound like a good deal? The thing is, the way VIX is marketed to the public is what? Right? They have you buying all the crap up here. Right? Now, Mark does a really good video of why VIX is a good thing to use as a hedge. Are you implying that most of the VIX options trading are for hedging? Yep. And the reason is simple. You can buy let's say you want to buy an option at a 16 VIX, Andrew. Right? And you're like, well, why would you want to buy a 16 VIX? Because at least you're going to be. You could go to YouTube, Jim. I think you know what? He did it, and it's an option pit in our archive. I don't know if he posted it to YouTube, but just try. But the easy example is this. You know that with VIX right now is basic. Let's just call it 11, and you can buy a 16 call. You know the distance between those two is not going to change very much, right? VIX can go down a little bit more, but not much. But basically, you're trading 11 VIX and you're buying the 16 handle on the call. If you're using the SPX to hedge, the SPX can run 50 handles, and your protection is now 50 handles out of the money, right? Your VIX call will still be relatively close to where the vol's trading. Does that make sense? That's why people use it. Well, you're asking that question because you take my class, Michael. He's saying, why wouldn't you buy the 13.5 put? You could. But you're also spending more for the put, right? Well, we can price it and see which one looks better. Right? Because I'm still mindful of the fact that VIX could go up, right? And then the money you're spending on your 13.5 put, right? That's more money out of pocket. One of the things I've discovered with VIX is try to spend the least amount of money you possibly can for your bang for the buck. Right? I mean, ultimately when you buy options, I can't stress enough, we just talked about it this weekend, you buy as cheap as you can, looking for what you believe is, either higher implied volatility later, higher realized value, something to push the needle the other way. But, when it comes to buying, I still think the best thing is buy cheap. Right? It's sort of the same concept as when you spread, you want to sell spreads where you believe you have the most edge, the money is the fattest relative to whatever you think. And it's the opposite. But what makes VIX unique, look at that, it's already 7:29, I've only done 3 slides. So what makes VIX unique is the fact that the options that are near the money have the least vol, and the options that are away from the money have the most vol. Now, just describing how VIX actually trades, meaning it trades off the future, not the cash, does it make sense why that is? Right? What's the concept that we talked about last week? Do the futures move to the same delta as the cash? No. So you're looking for basically 2 times when they're going to move, right? If you're going to buy options in VIX, anytime you buy options, you want the underlying to move, right? So VIX is going to move, we're going to look, right? There's only a couple times where that future is going to move enough where you care. Okay? One of those times is between now and expiration with a week to go, if there is a lot of contango in the put. Right? If that future is expensive. Because that distance it potentially has to travel is a long way. The fact that VIX might drop lower, it's possible, but that just, that's just more of a good thing. Right? I don't count on more of a good thing. Okay? So a couple things about the VIX zones is, okay, right, and you can argue with me about this, right? But usually when you're in zone 1, the realized vol, is it lower or higher than where the VIX is trading? Right? It's usually lower. Right? Look at historical charts. 95% of the time until it changes. Okay? Now, once we're trading 14 to 18 VIX, where's the realized vol? Realized vol is about fair. About where the VIX is trading. Okay? Because you're getting there, right? Once you're trading 19 to 22, usually, okay? Once you get over, let's say VIX trading 23, almost always, for an extended period of time, the realized vol is actually greater. Right? So, well, just when you think about it here, and I'll shrink this a little bit. Right? All I'm looking for here when you have that kind of movement is position, is kind of how you want to think about trade selection. That's all. Right? Right? When you're moving up in the zones, that's a kind of trade. Once you're in that higher vol range and things start to die a little bit, you just get that little slowness, right? And again, we'll talk about moving up range, down range, and VIX once we get a little farther in the course. But these are different positions. I'm not looking at this contango position in zone 2 or zone 3. Okay, this like 1 week vol trade. Mostly too because the options aren't going to be priced anywhere near where they are right now. The same trade we're looking at right now would not be $1.20 in net premium cost. Okay, it would be like $4. Okay, it's a totally different trade. So what we're looking for right now, okay, and wide right. What we're looking for right now is what is working or what has good potential. Right now, you've seen it now too. Since we started the vol class, we have the same vol condition. We've been riding mostly the contango down with upside hedge, trying to spend minimal dollars on it, and so far we haven't had to be stopped out on anything, just because that's what we have. But I'm mindful that the market might turn around. What I have to make sure is that if we do flip, that your position makes you is at least right, makes you money. So I think of things as I want to ride what I think is going to happen, and I expect to make money in that direction. But if things move in the opposite direction, in this case, because we're using volatility as a direction, I'm either going to break even or have a small loss, and I can exit. Okay, that's the idea. I'm not trying to make it overly complicated. Right? You can take that and carry it to any trade you want. Okay. So what I'll say here, and this should be a little review, right? Much of the VIX and vol product positioning depends on the zone because a certain move is expected. Right? When you walk into a day where VIX is 19 to 22, right? There is a certain expected move for the S&P 500. Right? You're looking at 1.5%, almost 2% a day. What kind of vol product trade is that? It ain't this one. Right? Right now you're looking for volatility to get off the mattress. So do you guys see how it's just a different world? Right? So you can try to take a punt on volatility, or you can be mindful of the trade you want based on where vol is trading and what the market is presenting you with. Does this make sense? Hopefully a little bit. Okay. Here is a tenant that it's in our gold class, yeah, class 5. And basically, just after watching markets, the tendency of options to move toward the dominant vol driver. Okay, that's what they do. The thing is, what you have to do is, if you're going to put on a position, if it's an iron condor, if you're selling put spreads, whatever, you're trying to figure out what makes the position move. Sometimes that could just be a straight delta. That's it. Market moves up and down. If you want to trade the vol products, right, which is what our class is, the series is about, you have to figure out what the dominant vol driver is. What's the dominant driver of the direction? Well, and then somebody's asking me, what happens when time changes? Okay, so these are ways that the concept of vol gravity. Vol gravity is just options moving to the driver. If the market is crawling along, those options should slow down. If we had very high realized vol, which is making the option prices ridiculously expensive, and all of a sudden things start to slow down, even just a little bit, you can feel that compression coming in. Okay, if vol is a little bit cheap, and they're just selling the crap out of it, and then all of a sudden it stops and things start to move away from the strike and you have expansion, different. Right? These are all things that you want to understand depending on the kind of trade you want to put on. Right? So I have here just I would say this is you could probably define a lot of vol movement broadly with these four categories. The VIX futures to the cash drives the vol products and the VIX options. Options to realize vol, okay, that will drive expansion near the money for the most part. Term structure and time spreads, those are how any kind of horizontal trade you look at. And any kind of compression due to changes in underlying toward the strike, anything like that. Right? It's basically what we call it option pit, our 3D vol structure. One thing I don't mention here is what? Right? What is the euphemism for volatility when you talk about options? I'll give you a hint. It's in the model. As an input. Tick tock, tick tock, tick tock, tick tock. Thank you, Adam. One of our best traders in our room, he came up with the right answer, so that made me happy. Okay. Forward volatility, we could kind of stick that in here somewhere, maybe time spready. I know, wild guess. So one thing we haven't really discussed yet is, we looked at something very short term, but so let's ask a question, right? Do you think short-term options in VIX behave the same way as long-term options behave? Right? The fundamentals are the same, but the things that are pushing the pricing are there's let's just say here, right? Look at here. There's definite dominant drivers if the trade's expiring in a week or if the trade's expiring in 60 days. Okay? So I have an example of that for you here too. Here's a couple of things just about trading VIX options. These are just broad generalities. Again, these are some option pit contentions. Maybe people argue with them, but I don't really care. I don't listen to them anyway. It's easier to be bearish when we're in contango in the options because of the way the futures decay. It's just what it is. It's easier to be bullish when the market is flat or backward. Okay? So are you saying time to expiration in the model and time to expiration for the contract, Douglas? But time and volatility are, if you looked at our, I did that in what, class 2, right? There's a relationship between the two. So if you're some of the things, if you're bearish, feel free to buy puts or sell call spreads. That's something our fund does for VIX. Combinations of options. Puts near the money trade cheap, and they can be in the money on the parity test for the future. So it's just, you're giving something. Call spreads, how far out and how close and wide? As far as what our fund does, I'm not telling you, but just from option pit, there's an optimal spot, CC. We'll talk about that a little later, but I'll give you a hint. It's not too far out, and they're not too wide. So why would you want to sell VIX call spreads over VXX call spreads? again, it goes to the nature, I think, Scott, of the product and how VIX calls. VIX operates in backwardation, where the cash moves but the futures don't move. So there's a little bit more of a delay. VXX is going to move when the futures move, right? VIX can stall, the futures can stall a little bit, which if you're selling premium, you want. Does that make sense? Right. So VIX has less of a delta than VXX does, basically, which makes it interesting. There you go. That's a good way. Nick's saying VXX is round and VIX is sharp. Okay. Some more stuff. For bullish play, selling naked puts, unless you're in zone 1, it's just hard to sell naked puts in VIX unless your timing's great. It's the bottom line because it goes. The puts expand over time, just the way it is, until they don't when VIX really starts to drive. Put ratio spreads and stuff like that generally work okay. Owning calls are okay as a hedge. I always think of if you're going to buy calls in the VIX, you have to be making money somewhere else. I think of it like that. The cheapest bullish trades in VIX are call spreads and flats and flat to backward markets. That gives you the best. One of the things when Mark next week, we talk about a backward market, very different from a contango market, is VIX options start to move once the futures get flatter because they start to kick more. The underlying's moving. It's not moving much right now. It's very hard to buy a call right now and make money. It's just the nature of the product. It's like waking a sleeping beast, If the bear's asleep, bear's asleep. Once he wakes up, you better get the hell out of the way. There's really there's no tween there. It's either he's sleeping or he's awake. Sleeping is good, awake is bad. It's just I don't think there's a between. The bear gets up and he's groggy. It just doesn't work like that. And ratio spread trades are great when VVIX or the implied volatility of the VIX options is low, like it is right now. Again, that'll be a topic that Mark covers next week. A flat market will be flat to backwards is on the futures, Michael. So do you remember that chart I drew last week of all the VIX curves? Right. A flat market for VIX is when the near-term options are trading very close. The near-term futures are trading very close to the far-term future. So when we were discussing that, what does that mean from a trade point of view? Right. So if I'm a liquidity provider, you're a liquidity provider, and the future term structure looks like that, right? What are you thinking in your head? You're uncertain. I don't know where vol's going, but I think it's going somewhere, and it's going to go there in a hurry. So again, same concept. You buy options when you think the potential for underlying movement is great. Or you buy options when you think the implied volatility is so low you can't lose any money. Those are the two best ways to buy options that I know of. Okay, from a gamma, basically delta neutral concept. Okay. Now here's what I want you to notice about So we looked on, I think, a trade on from the 23rd. Do we care about how what VXST is doing? That's the 9-day VIX. I think it's a lovely indicator, Scott. But ultimately, once you have futures on a cash index, the value of that is much more. So what you could use at VXST is, oh, it's going up, it's going up, it's going up. Maybe the futures are going to catch up a little bit. But none of the current futures are on that product anymore, on that index. But it could be something like, oh my God, it's spiking. Okay, what's out there? So one thing you noticed is here, has VIX moved a lot since the 23rd of January? Not really, right? Okay. But an idea that we had in our strategy letter was, trying to buy low vol. I think we had this week. We looked at it week 1 for our vol class, where what I want you to do is, even though the VIX didn't move one, look at how much the March 14 put moved from $1.70 to $1.15. Okay. So net, right? And we bought call spreads against it. Again, we'll talk about that today, but we paid $1.15 for the call spread. We've paid $1.15 for the put. Right. And at the time, my posit for you was, by the end of the class, you'll understand why I wanted to do this trade. Okay. Now, after just what we've talked about, why would I want to do a trade like this? What's interesting about this trade? Right? The fact that my 14 put, right, where remember that March future was so expensive relative that it actually really drove the value of this put higher, even though the VIX did almost what? Right? The VIX did almost nothing, but what moved? Right? The futures. Right? This trade was put on for the express reason of the March future was expensive. I expected it to start to go down to the cash, right? And we were hedging it by buying this call spread. Okay, now we had 10 of them when we sold 2 of the puts for $1.55 or $1.60 or something. Because we're getting very short delta, we want to unwind it. But what I want to try to get you is, this is a March contract, and even though the VIX hasn't really done anything, there is movement, although it's not huge movement, underneath the market. Do you understand what I'm saying? Right. The point of this is, when I say futures are expensive, what are you looking at? I'll tell you in 2 seconds, CC. Okay. There's kind of glacial movement under where the VIX is. Like, VIX isn't moving, but something's kind of moving. Right? So one thing when you position in VIX, or you're trying to look for what I want to set up is a way for you to look at how to create an opportunity. Like, is this worth doing? Right? So here, we had lows in VVIX. Like, the vol of vol was very low. And future premium was relatively high. So over cash. So when we looked at this, I'm like, wow, that's a good opportunity. At the time, I think VIX was trading 11.25, right? So VIX is trading 11.25. What's the intrinsic value of the 14 put, right? $2.75. Even if it was trading 11.50, I think at the time, that's still $2.50. And I can buy this strangle for how much? 115 for the put, and where is my call premium? 2 and 85 and 1 for, so I could actually buy a strangle in the VIX for less than the intrinsic value at that time. Remember what my test was at the last class, right? Close your eyes. Expiration is tomorrow. Where does it settle? Okay. So this trade is working a little, but again, it's doing what I expected it to do. If vol actually took off, right? If vol actually took off, what would happen to the value of our strangle? It would make money, right? Because we would have the delta, and then we'd also have the vega that we're long, right? Sometimes what's really weird is you'd see the vol explode, your put barely moves, and the calls blow up. Okay, so this is what I'm going to say is this is a strangle that was in the money, but it's a slow-moving strangle. Does everybody kind of see that? The puts won't move, Michael, because the volatility in the put goes from 75 to 135. Okay? You will not believe the value of what this thing would be if VIX traded 22. Okay? It would boggle your mind. It would be huge. I'm almost getting to the point where we can hopefully take off some of the 21 calls, my short calls here, just a few, right? And leave on, I want to not take off the puts, but maybe just buy some of these calls where they get a little cheaper, but that's a big part of our decay. You know, you're starting to just tick them off, like take a couple off, take a couple off, take a couple off, because if we then get an explosion, they make a lot of money. But right now, it's just melting, right? And melting is fine. But what I want to show you from the last slide is even though the cash doesn't do much, if the trade you put on is receptive to the future declining, the position can do okay, right? So I can still own what I would call as a long vol position, and even though volatility is declining, I'm making money. Isn't that magic? Nobody thinks that's magic. You're long vol, and the vol is declining, and you're still making money. I think that's pretty good. Thank you, Kurt. Somebody said it. Okay. So this is a midterm position, but it's the same. What I want to do now is let's try to structure how you set these up since it's already 8 o'clock and I'm supposed to be way into this by now. Okay. So notes. VIX options will lose slower in the longer term because of the VIX future premium. Okay. That's expected. Okay. If you buy VIX options with 30 days or more to go, with the expectation of, man, these things are really going to kick some ass, you got a long wait. Okay. Now, if we turn around tomorrow and something awful happens and VIX blows up, that's a different story. Right? So Nick's saying it's like pricing any strangle. The cash to the future, you can buy options less than you can make. Right. What he's saying is you have a chance to buy options a little cheaper. Now what happens is they will move fast once volatility of VIX, the vol in the VIX, starts to expand. They will move very fast. Okay. They will move really fast once the VIX futures accelerate into either flat or backwardation, when actually there's actual movement in these things. Okay. The last rule to remember is they will gravitate toward VIX cash at expiration. Okay? So if I use these as kind of loose rules, how do we create something out of that? Right? So now you have to start to, we want to quantify. So a couple of relationships, right? How is VIX going to move when the S&P 500 moves? So another part of this is if you have market opinions, if you're new to VIX, you have to have some expectations on how it's going to move. Okay? So where is VIX relative to the cash, right? Is VIX at highs, lows, or normal? Mark's really good at this intraday, and when it's actually interesting, meaning the market's moving a lot, but the VIX is doing strange things, right? Those are usually the biggest signal. Okay, so when the VIX is at a low and the SPX is at a low and the VIX is at a high, all that means is people are freaking out, which is normal, right? You can't divine much from that. Just vol's higher, market's moving, changing zone, right? When the VIX is at a high, when the SPX is at a high and the VIX is at a low, it's somewhat converting, meaning we're just moving up the curve like I said last week. What can be annoying is I'll keep saying, like we talked about last week, the last class. Because VIX should decline as the index goes up. Right? That's normal. Right? It's because it's grabbing, it's just using lower and lower volatilities in the weighting. Okay? So when the SPX is at a low and the VIX is not at a low, that's fairly contradictory, meaning the market's sold off, but the VIX is not rallying. Right? The SPX is at a low, but the VIX is not at a high. So what's basically happening is options are not buying the sell-off. Okay? So what I would look at there is there could be a turnaround. So pricing trades, you price trades for a turnaround is something you might expect, and then a sell-off would be something you don't expect for. Remember, you price for the things you expect, and then you hedge for the things you don't expect. Okay? And if the market is not at a low, but the VIX is at a high of the day, the market is likely to head back toward its lows. Meaning, it's amazing how good volatility traders are about divining. And also, don't forget, the VIX is the sum total of all participants. Right? So if VIX just keeps climbing, I'm going to say 8 times out of 10, the market will respond eventually when it's really stiff. Today, VIX kind of fell, didn't do much. The futures are, again, this is one of those things where volatility gets so low, it's hard for the VIX futures to find sellers. Meaning, nobody's ready to step in and start to pound them down. And since you have a week to go, they get a little illiquid, whatever. But now, as you get closer to Friday, that's if that premium is going to leak out. That's when I think it will happen. Friday, over the weekend to Monday, because they're not ready to just let the weekend go. Okay, and that's what I think is happening with the VIX futures now. Lastly here, if the market is not at a high, but the VIX is at a low of the day, the SPX is likely to keep rallying, meaning they crush the VIX fast in anticipation of rally. And usually what that means is they're taking the bid out of the puts, the SPX puts. Right. So now, let's go through our one example, 15 minutes late. So what we want to do is first step is we want to identify the opportunity in the VIX futures. I did hit record. I'm really happy about that. Okay. We want to quantify whatever the risk is in the direction. We're going to try to create the position. When I say the active end, that's the side I want to make money on, and the non-active end is our hedge side. We're going to try to figure out a financing mechanism. So anytime you buy options, you're looking for a financing mechanism. Anytime you sell options, you're looking for an adjustment or exit mechanism. That's it. There's no other way around that. You either are getting out or you're trying to adjust if possible, if it makes sense. And then lastly, you're trying to how do I manage the strategy? The super great idea I have some edge, but what do I do with it if something happens? Okay. And the important thing about managing the strategy is closing stuff. Meaning, oh, the vol's moving, the vol's up. Right now I could sell my call spreads for almost what the whole position was worth. Right? If you don't start to close some, there's nothing I can tell you. You got to close things when the opportunity presents itself, because that opportunity could be real small. Right? So again, we're going to keep repeating the method, and what we want to do is continue to fill in the blanks. Futures are here, vol's here, market's here, blah, 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 blah. Keep filling in the blanks for the types of what positions we're looking at with vol products. And you could also probably do this just, if you like to sell iron condors, what makes you want to sell them? If you like to trade flies, what are the things that make you gravitate toward the fly? If you like to buy juice, what makes you gravitate toward the juice? Go through the steps, okay? So, in zone 1 or zone 2, which is where we are, this was a question I just had. Normally, the key date for VIX futures is always what? Where does time start? Right? Where does time start? Okay. So an option pit, this is what you care about. Time starts at VIX expiration. And the reason why, since we're trading vol products, and I should actually write serial expiration. Okay. Why does that mean? So when I start shocking vol and doing the vol products and understanding the potential move from a vol shock, okay, VIX futures trades the serial options, right? So they're trading the Feb, they're trading the March, they're not trading the weeklies. For us too that's when time starts, because things start to tick tock, right? I have 30 days to go to expiration. That's how the VIX works. So my March is getting there, my Feb only has a week. Okay? Doesn't matter what happens. I know that future is gone in a week. Okay? So, right, observation again, right? Normally what happens, you're in zone 1 or zone 2, your front month contract should be about $2 over the VIX on expiration. So, under normal circumstances, my March contract, okay, next week should be about $2 over wherever the cash is. And from the same reason, VIX basically decays around 50 cents a week, the future, just 50 cents. 50 cents, 50 cents, 50 cents, done. Okay? There's no brain surgery there with that. Okay? Right now, if you notice, my March is trading at around the 14, right? The 14 level, which is $2.71 over. Okay? A little expensive. Not near as expensive as it was when we put on our trade before in March. Okay, I think that as an opportunity is passed, which is why we're starting to sell some of the puts, maybe trying to buy some of the calls back, and look for a potential reversal, whenever it happens. Right? All we're doing is just managing the delta of that trade. But what that also means is, with a week to go, how much premium should be in there? Right? We got a week to go till our Feb 15 expires. How much premium should we expect? 50 cents. Right now, we got a heck of a lot more than 50 cents. It's more like $1.21. So do you see why that generates an idea? Why we feel that there's edge there? Okay, so we're looking at just a relatively stiff number. We're in zone 1, right? We're in zone 1. Those futures are a little expensive. I don't know why. You know, it could be the euro, could be this, could be that, it could be the next Trump. Who knows, right? I don't know. All I know is if that cash level stays here till next Tuesday, which has a good shot, right? This future is going to be, 1140. But then all of a sudden this trade is interesting. So again, and normally what happens, and then all of the contracts sort of feed from the first contract. So under what I'm going to guess, this is normal contango. The next month contract should trade about $1 over, so about $3 over. Right now it's trading a little more than that. A week to go, not too much more, but a little more. Makes sense with VIX so low though. And then the April will be another 50 cents over that, and so on and so on and so on. Right? Until you get to somewhere right around 20. Okay. We're not going to concern ourselves with the back month futures, mostly because there's no vol products to trade on it. And trading back month VIX is really only an exercise in vol, to be honest. You would be surprised how little those contracts move. Right? And the reason being is, look at the October future, right? Is 1860 or 1865, and the cash is 1129. I mean, you really think anything is gonna? What's gonna make? What does this VIX have to do to make this October future contract move? The delta on it's like 15. And then by the same token, if you sell options out there, how long are they going to take to decay? You might as well watch paint dry. It doesn't mean you can't trade them, but they move differently. Okay, so what our idea is, at least for today, is trying to just generate this trade. So I've got that we have the Feb 15 cycle. That's next week. I have $1.31 in intrinsic value for the 13 strike. Hopefully that's still correct. It is. Nope, it's changed. The 13 strike is $1.71. When I was writing this up this morning, again, that's part of the problem of trying to do something live. Actually, it's more. Okay. So, right, the reason why we have any edge is the futures are still a little expensive. What you're trying to do, if I create a strangle around the two, it's going to cost me $1.50 for the strangle. Whoopsie. Which is still below parity. 21 cents. With SPX vol still below 10%, your gravity points continue still downward. So I'm not saying the market can't move tomorrow. Whatever could happen. All I know is if things continue to happen, what pulls these products down? Okay. So what I want to do here is, instead of paying 50 cents for the call, can I do it for less? So let's look at the contracts. Yep, that's what we're going to do. So I have the 13-16 call spread. I think we could get for 32 cents. Maybe better. Or we could trade a fly. Okay. So if I look at it, the 13-16, 19 fly would cost us what? So if I pay, let's say 50, I sell 36. So that's 57 and 36 is 19 cents for the fly. So 19 and maybe 95, we're into it for 114. That's not so bad. You're basically paying 114 for this strangle. Right? So the fly, whoops. Oh, yeah, sorry about that. Okay, so our fly here, if we do the Feb, what do we say? 19 cents, something like that. Pretty cheap, right? Can the fly be a standalone trade or buying the put? Of course. I mean, the put can be a standalone trade. The thing is I don't think you're going to really see the decay till Monday. So basically, the idea of this trade is I'm not really going to get the collapse until Monday. So that means you've got to hold it for the weekend. So what do you want to spend to hedge the weekend risk of whatever the hell happening, right? Because you could get a shock for VIX. This fly could be worth $1 easily. You close it, and then if you do have a little pullback in vol again, your put could be worth something as well, right? You might even do better, right? Because what is going to happen with that future? Let's say on Monday, do you think it's going to be very sticky to the cash price? It is, right? That's the magic of how VIX gets once you get close to expiration. It gets very sticky, especially when it starts moving, because all of a sudden, who knows? Right? So in this case, I'm trying to find the minimum, or I could spend price to call spread, which is, right, for the Feb 15, 13, 16, call spread, what was it, like 38 cents or something? That 50 and, what was it? 50 and 18 is 32. Okay. Oops. So, it's one of those things where it's only the difference between, I like the idea of being able to close the call spread easily. So for only 13 cents, I'd probably just go with a call spread. You could, Michael. Yep, if you own VXX calls from anything else, that could be a hedge. Depends how close they are. You could do the 13, 16, 18 as another trade if you wanted to. That's why I'm just saying the call spread is a choice too. I would rather spend 13 extra cents and just have a call spread I could close, to be honest, in this case. Because it is very possible that we just trade like 1075 and nothing happens again, And all of a sudden, those 13 puts are way in the money. Okay. But you see how I'm trying to identify the edge of our trade? I'm basically just saying the potential move for VIX is more than they're pricing the strangle. I want that. If the potential move for VIX is much less than they're pricing the strangle, I don't want that. Right? I'm not trying to make it super difficult. Right? So when I go through this now, just as we wind down, right, you have an abnormally high VIX future premium near term with a possible collapse. Right. Well, I'm not trying to reinvent the wheel, Nick, because it's the same as all the other strangles and straddles we price. There's a method to it, even though it just doesn't sound like it. So, yep. Now, short calls is a more aggressive way to do it. See, the thing is, once you see how this is set up, you can choose how aggressive you want to be, right? You don't have to buy call spreads. You don't have to buy flies. Hell, you could sell calls against it if you want because you don't think VIX is going to do anything, right? I'm always going to be of the mind that I will take the least risky way to do anything. You can always add, you can always be more aggressive. You know? You can always be more aggressive. But what's important is, do you guys understand you might have gone from being a buyer of calls and VIX, now you're going to buy puts before you buy calls. So if you learn that, then you're learning something. Right? Because when vol's this low, it costs you almost nothing to buy a put. And those are the things that pay. Right? They pay 9 times out of 12, and the times they don't, you have the calls that at least you break even. Or sometimes, you have an August, debacle, and then you're like, oh my gosh, I can't believe how much money I just made. It's the way it is. But the thing is, you got to wait till, for this type of trade, what are you waiting for? You're waiting for zone 1. You're waiting for a lot of contango, right? You're waiting for things to happen, right? Does this setup happen every day or every week, right? It's kind of been miraculously happening for us like the last 6 weeks. We've had something like this on almost all the time. But that's because that's what the market's giving us. It's not that we're doing anything genius. We're just repeating the same thing because we keep getting presented with the same thing. Right? So you quantify the risk. The risk here is a 13 pin. Even then, your strangle is going to have value, right? VIX strangles rarely go to 0 the day before expiration, right? It's also the nature of the product. It's hard for VIX just to go up 1 or 2 points and stop. Right? It either goes up to 1 or 2 points and keeps going, or it retraces. Right? It's how it works. Right? Because all of a sudden, you think about it, you get a bid for vol, you get a bid for VIX. If there's no continuation, all of a sudden liquidity providers know what's going on. They're like, I'm not going to bid the vol 2 points higher than it was yesterday for no reason. Right? Right? Your in the money put and your call provide the head start. Right? Our financing mechanism for this trade is decaying into cash. So everything goes perfectly, just the trade is self-financing, meaning the option premium we pay for doesn't cost us anything just because the future keeps decaying. Right? Our delta, right, becomes our trade. And then finally, we just close the call spread on a rally. Like I'm saying, if you're trading 15 VIX all of a sudden on Friday, close the call spread. Take the dollars you have and your puts for a small credit, and then see what you get after that. Okay? All right, well, not too bad. 821. We just did one trade. So what I'm showing you here is zone 1, high contango, very front end of the curve. Right? So if you think about it, right, if you're looking at this, we're looking about trading on a very, very, very narrow part of VIX. Do you guys understand that? Is this a strategy for all time? right? No, it's a strategy for when vol is really low and you're still looking for where there is premium. Right? There's premium in the VIX futures, and it's either going to stay there and evaporate, or something goofy is going to happen with the market, and you've got to have a position that'll be ready for that. If you're long extra vol put somewhere and vol call spreads or something like that, that's fine. But that's how I see to trade VIX right now. Right? And as Nick has seen, straddles less than $1.50 are nice. Right? $1.25, even better. So you understanding that we're looking at, again, and Mark's going to do more VIX moving up. Totally different ideas on how to trade this and what the expectation is, right? Here your expectation is you're trying to make 50, 75 cents on the trade, which is a good return. 50 cents, I think you're up 50 cents, you're closing. And that's great. It's not a massive expectation, but it looks, it's got edge in it to do it. Right? And it's because those futures start so expensive. That's why you have to go through the process. Right? Questions? How do you think about how aggressive to be when selling off the call spreads on a rally? Normally, Michael, I don't think too much about it. The easiest thing, obviously, is once your call spreads pay for the puts, I'm starting to sell them. Like literally, once that's that expensive, you're getting rid of at least half. Because also, too, you're going to be longer delta faster. So that's what I would say. It's kind of the same rules about trading this is if you're breaking out of kind of zone one, especially in this case where you have a shot, you got to be mindful that you want to close them, but you would want to ride them, but at the same time, you're looking to close them. You can certainly do that, CC. Yep. I mean, my favorite way to do this, okay, we spent $1.25 for it. I sold the puts at $1.50. Now I have the calls for quarter credit, the call spread, and then who knows? Right. So that's one of the things with the strategy is you close the call spread on the rally, but you close the puts once you're up decent money net on the whole thing. Just thanks. It slid down. I'm just taking the money and I'm going. Normally I would say you're going to get probably 70% of the money you're going to get by Monday on a trade like this. If you're going to make money on the put side, you're going to make 70% of it by Monday. Because those call spreads will hold on for a while. They just don't go to zero. They might not go up, but they just don't go to zero. And then you make your money on your puts. That's it. But that's the thing. Watch the trade. Watch how it works. The easiest way, that's what's important about this masterclass, I want to give you a trade to watch per week. This is trade 4. So far, I think we're 3 for 3, right? There's no guarantee about being 4 for 4. But this one, I think, is a good head start. Because everything is backward. Well, I think that's how the products lend themselves to that. All right, guys. Hopefully Mark will get this out tonight. Is there somewhere to watch the futures on live vol, Evan? There's a 10-minute delay on this one on VIX.com. They have the tick for the futures on Thinkorswim. I mean, you could pull up VIX future on Thinkorswim. VIX Central this is delayed, but at least it's there. You don't get the weeklies yet, though. I don't know why he hasn't updated to get the weeklies, but let me see here. Oh, here we go. There are your weeklies. Duh. They're delayed, but they're there. That's free. Tell you, Mark and I just should have built this website. We probably would have done better. It's a lot less work. Oh, also, that's right, CFE.com. They will give you, they're slightly delayed, but they're there, the tick. So those are two free places, but you won't ever get live data unless you pay for it somehow through a platform or something. Okay. If you have any questions about live vol, you want to get a reduced price on a commission through there, let us know. We'll do what we can. I think we can save you like a nickel a contract. All right, guys. Have a good evening. We'll see you tomorrow. It's another day of watching paint dry. Take care.